In this video, we're tackling a topic that is often shrouded in myths and misconceptions: credit scores. Your credit score plays a crucial role in your financial life, impacting your ability to secure loans, obtain favorable interest rates, and even rent an apartment. But there's a lot of misinformation out there. In this video, we're debunking common credit score myths and separating fact from fiction. So let's dive in and uncover the truth about credit scores. One of the most common misconceptions is that closing credit cards will automatically boost your credit score. However, this is not entirely true. Closing credit cards can actually have a negative impact on your credit score, especially if they have a long credit history or a high credit limit. It can reduce your overall available credit, increase your credit utilization ratio, and shorten your average credit history length. Instead of closing credit cards, it's often better to keep them open, especially if they're in good standing, to maintain a positive credit history. We have a comprehensive course that talks about building and boosting your credit. This course covers a lot of topics such as credit utilization ratio. To make things easier, we'll include the sign-up link in the description if you're interested in fast credit repair or boosting. All right, let's talk about myth number 2. Another widespread myth is that checking your credit score will lower it. This is completely false. When you check your own credit score, it's considered a soft inquiry or a consumer inquiry, which has no impact on your credit score whatsoever. It's actually a responsible financial practice to monitor your credit regularly and stay informed about your credit standing. Contrary to popular belief, your income is not a direct factor in calculating your credit score. Your credit score is based on your credit history, payment behavior, credit utilization, length of credit history, and other factors. Your income is not reported to the credit bureaus and does not influence your credit score. However, your income may indirectly affect your ability to obtain credit, as lenders consider your income when evaluating your credit worthiness. Some people believe that carrying a balance on their credit cards and paying interest will improve their credit score. This is not true. In fact, carrying a balance can lead to unnecessary interest charges and potentially harm your credit score. It's best to pay your credit card balance in full each month to avoid interest charges and maintain a healthy credit utilization ratio. Closing an account does not remove any negative information associated with it from your credit history. The credit bureaus keep a record of your credit history for a certain period, usually 7 to 10 years. Negative information such as late payments or defaults will remain on your credit report for the designated time, even if you close the account. It's important to address and resolve any negative issues directly instead of relying on account closures to solve the problem. Contrary to popular belief, there is not just one universal credit score. There are multiple credit scoring models used by different lenders and credit bureaus. The most commonly used credit scoring model is the FICO score, but there are also Vantage score models and other proprietary scoring models. Each model has its own algorithm and criteria for calculating credit scores. It's important to be aware that your credit score can vary depending on the scoring model being used. If you'd like to know about FICO and Vantage score models, watch our other videos about these topics. Let's move on to the 7th myth. Closing old accounts can actually have a negative impact on your credit score. Your credit history length is an essential factor in determining your credit score. When you close an old account, you're shortening your average credit history length, which can lower your credit score. If you have old accounts in good standing, it's often better to keep them open to maintain a longer credit history, demonstrating your credit worthiness over time. Paying off collections does not automatically remove them from your credit report. Collections can remain on your credit report for up to 7 years from the date of the initial delinquency, regardless of whether they're paid or not. However, paying off collections can have some positive impact on your credit score, as it shows that you've resolved your outstanding debts. It's important to work with the collection agency and ensure that they update the status of the account on your credit report once it's paid. Credit scores are not used to determine your employability. While employers may perform background checks, including credit checks, they typically focus on other aspects such as criminal records, employment history, and professional qualifications. However, in certain industries where financial responsibility is crucial, such as banking or accounting, a credit check may be a part of the hiring process. But for the majority of job seekers, credit scores do not directly impact employability. While paying your rent is an essential financial responsibility, it does not automatically boost your credit score. Rental payments are not typically reported to the credit bureaus unless you use a specialized service that reports rental payments. However, if you miss rental payments and it leads to eviction, it could have a negative impact on your credit score if it's reported as a public record or collection. And there you have it, the truth about credit score myths. It's essential to separate fact from fiction when it comes to credit scores. Understanding how credit scores work empowers you to make informed financial decisions. Remember, maintaining a good credit score requires responsible credit management, timely payments, and a long-term approach to building a positive credit history. We hope this video helped debunk some common credit score myths and provided you with valuable insights. If you are seeking a practical guide to effectively repair your bad credit or enhance your chances of faster and easier loan approvals, we invite you to sign up for our comprehensive course. This course offers a thorough walkthrough of all the essential aspects related to credit scores, equipping you with the necessary knowledge. The link to enroll will be provided in the description. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to our channel for more informative content. If you have any questions or want to share your experiences with credit scores, please leave a comment below. Thanks for watching, and we'll see you in the next video.